Hi everyone, this is James Tompkins and this is the fourth lecture of the Corporate Finance series. And what I'm going to do is I'm going to start off the way I usually start, an agenda, and I'll begin with a summary today, meaning specifically why am I doing what I'm doing right now? Why valuation of stocks and bonds? How is this relevant? How does this fit into everything else that we're doing? And then we'll get into the topic itself. I'll have a general discussion of financial securities. And what do I mean by a financial security? Or what are some examples of financial securities? Well, actually, stock and bonds. And so, of course, we'll get into more detail about that later. And then I'll talk about valuation of bonds and valuation of stock and some of the terminology involved. And in doing so, we'll actually make some broad statements about many other types of financial securities that exist out there. So let's put everything into perspective at this point. So we began basically with a model that measures value, the time value of money model. And why did we begin with that? Well, what's the broad theme of this class? Well, we're looking at financial principles as it affects firm value, and in particular, our primary focus is on which decision? Do you remember? The asset investment decision. For example, the decision for Apple to invest or spend money on scientists and software and infrastructure and so on and so forth to develop the iPhone. Was that an asset investment decision? It was, right? And that's our primary goal in this particular class, to get into the principles that will help us make it not guaranteed, but more likely that we'll make good decisions or value-creating decisions. So why begin with a model for measuring value if the theme of this class is financial principles as it affects firm value? Well, if you're going to manage value, does it help to be able to measure it? It does, right? So for example, if you were going to go on a diet, what would be a really useful instrument to have? A scale. I mean, if you had a scale, not only can you tell, hey, I'm gaining weight or I'm losing weight, and therefore tell if your diet's working or not, but you could say, well, how much am I losing? Or how much am I gaining? And so how well is my diet working? So like I said, we then took this time value money model and we applied it to the asset investment decision. And when we did that, in theory, what had to be true for it to be a value creating decision? Do you remember what the bottom line analysis was? This was in lecture 3. Well, basically it had to be positive net present value, right? And what two items, just like the time value money model, what two items did you need to have to figure out the NPV? Well, number one, did you need the cash flows? Right, the relevant cash flows. What else did you need? What two things do you need to value anything per the time value money model? A discount rate, right? And in this case, of course, if it was the asset investment decision, we needed the discount rate that applied to the asset investment decision. So basically, lecture 2 in this series was time value money. We figured out we needed two things to value anything, cash flows and a discount rate. We then applied that to the left-hand side of the balance sheet. We said, hey, forget about how we're choosing to raise capital. Let's just focus on this asset investment decision right there. And the two things that we needed for the NPV were cash flows and a discount rate. Now, at that point in time, we did assume that we were just given the discount rate, and we'll take care of that in a couple lectures. But right now, what we're going to do is we're going to move to the right-hand side of the balance sheet to value stocks and bonds. And when we value them, what model do you think we'll use? Well, I'm not going to suddenly change models on you, but we're going to use the time value money model. And again, what two things will we need to value anything? Well, cash flows and a discount rate. So in other words, we're going to move to this side of the balance sheet, the right-hand side of the balance sheet, and we're going to say, well, why is debt worth 40? And why is equity worth 60? And to do that, we'll need cash flows and the discount rate that applies to financial securities. But again, for now, we're going to assume that we know what that discount rate that applies to financial securities. In other words, that's just going to be provided for us. And we'll take care of that in future lectures. In fact, that'll be the next lecture. But for now, we'll assume that we know the discount rate, for example, that applies to the debt, or the discount rate that applies to equity. But like I said, we'll take care of that in future lectures. So let's begin with a general discussion. So imagine that you pay $1,100 for a financial security today. Maybe it's a stock, maybe it's a bond, maybe it's preferred stock, whatever. You pay $1,100 basically for a piece of paper, a contract. And that contract basically says, imagine this is between you and a corporation, and the company says, all right, well, we'll agree if you give us $1,100 today, we'll agree to pay you $50 every period. So here are periods. Maybe there's a 1-year periods, maybe there's a 6-month periods. Either way, it's specified in the contract. And then let's just say there's 6-month periods. So then 8 years from now, or 16 6-month periods from now, you'll get your last $50, and also you'll get $1,000. Now, by the way, just because there's a contract, and just because a company, quote-unquote, agrees to pay you those cash flows, does that mean that you're going to get these cash flows with certainty? Or are they, if you will, merely expected cash flows, and therefore a degree of uncertainty? They're expected, right? I mean, in principle, you could argue that anything that is after time zero, i.e. not today, in other words, anything in the future, could you argue, especially in the context of financial securities, that there's uncertainty involved? You could, right? So even if you lent me, say, $1,000, and I agreed, quote unquote, agreed to give you $1,100 back next week, is it possible that I might default and not give it to you? I know, it's hard to believe, but yeah, that's possible. I may not give it to you. In any case, imagine this is the situation we have right here. So here's my question for you. That financial security, is it a stock or is it a bond? Or do you not know? What do you think? A stock or a bond? Well, a lot of you, I'm guessing, said, well, that's a bond. I mean, here are the interest payments, if you like, also known as coupon payments when it comes to a bond, and here's principal. And so we're paying $1,100 today for a bunch of interest payments and then principal. And yeah, you could be right. But on the other hand, is it possible? And I don't mean likely, I just mean possible. Is it possible that these $50 every period, is it possible that they are expected dividends? And then this $1,000, for whatever reason, this is your expectation of what you believe the stock is worth in 16 periods or 8 years, if these are 6-month periods. Is that possible? It is, right? It is possible. And so for you to say with absolute certainty this is a stock or bond, the answer is you really don't know, right? In other words, you can't just look at this diagram and know with certainty, hey, this is a stock or this is a bond. And so therefore my question to you is, well, what does differentiate, for example, stocks from bonds? How do you know? Well, are there certain characteristics of stocks, say, that make them stock and differentiate them from bonds? They are, right? For example, a bond is when you, for example, choose to lend money to a corporation. And so if the company owes you interest and maybe they're having a rough time or whatever, and they just can't make the interest payment, then what do you, as the bondholder, have a right to do? Well, basically, you have a right to a claim to the assets. You have a right to begin bankruptcy proceedings. Now, what about if you're a stockholder? Suppose you're expecting a dividend and the company doesn't pay you a dividend. Do you have that same right? You don't, right? And so therefore, the fact that the bondholder has this, if you will, this feature where the company is much more incentivized to make sure they make that interest payment as a bondholder for the same company. Let's say this is Delta Airlines or whatever. So for the same company, is the bond going to be less risky to the bondholder or more risky to the bondholder? Relative to stock, that is. Less risky, right? You could think of it this way. The first cash that the company produces, who has a claim on that cash first? The bondholders or the equity holders? And by equity, I mean stock. They're one and the same. Well, the bondholders have first claim, right? And so therefore, if you're a bondholder, from the bondholder's perspective, is that safer for you than the equity holder for the same company, or riskier? It's safer, right? And if it's safer for you, then if you take all of these expected cash flows and bring them back to time zero to see what it's worth at time zero, then would you have a higher discount rate or a lower discount rate? Well, you'd have a lower discount rate. And so if you had a lower discount rate and brought these all back to time zero, then would it be worth more today or less today? More today. And we'll illustrate some of that a little bit later. But the bottom line is that essentially any financial security is nothing more than an exchange of cash flows between two parties with varying degrees of risk inherent in the cash flows. So if we go back to this slide right here, okay, well, this could be other contract features. This could be secured debt, unsecured debt, preferred stock, and I'll talk about that a little bit more. But basically, anytime you change something in the contract that changes the risk, is that going to change the discount rate that you apply to these cash flows? It is, right? So let me ask you this. If the cash flows are riskier, what happens to the discount rate? Goes up, right? So if we get back to this discussion, then what is safer, stocks or bonds, for a given stock, say Delta? Bonds, right? Because do they get their money first? Do they have contract features that make them safer? Like, hey, if you don't pay my interest, maybe I'll throw into bankruptcy. They do, right? So what would have the lower discount rate, stocks or bonds, for a given company? Bonds, right? I mean, of course, it's possible that a bond of one company might be riskier than a stock of another company. You have junk bonds, right? But I'm talking about for a given company. And as we've discussed, how do you know? How do you know what's safer? Well, basically, the various contractual provisions that we talked about. For example, bondholders, they get interest payments before stockholders have any claim on the cash. And if they don't get their interest payments, then hey, they can force them into bankruptcy. So my point is that you could look at this extreme and textbooks they keep it pretty simple. They typically talk about debt or stock, and they'll talk about preferred stock. But the bottom line is that there are thousands of different types of financial securities, and all of them simply have different contractual elements that affect the risk of the cash flows. And we're just focusing on two sides of the spectrum. So you can have secured debt and unsecured debt, preferred stock, participating preferred stock, non-participating preferred stock, common stock. There are even different classes of common stock. For example, some have lots of voting power and some have just one share, one vote, and so on and so forth. And so today when we talk about the valuation of debt and stock, we're just taking two ends of the spectrum. But what you need to know is that in reality, the same principle can apply to any financial security that exists on this spectrum. So essentially, you've got all these expected cash flows. How much would you be willing to pay? Well, again, what two things do you need to value anything? Cash flows and a discount rate. So in the end, that's exactly what we're going to do. We're going to figure out the cash flows and then apply a discount rate to see what it's worth today. And by the way, I know I talked about financial securities being an exchange of cash flows between you and another entity. What's much more likely, instead of being between you and the corporation, because when it's between you and the corporation, is that when, or is one example of that when the company is first issuing stock or first issuing bonds? It is, right? But when you buy Apple shares, for example, is there a flow from you to the company or vice versa? There isn't, right? That's basically between you and whoever's selling you the Apple stock, so another shareholder. But either way, what you're willing to pay today, is that based upon your expectation of cash flows in the future and the risk inherent in these cash flows that is reflected by its what? Discount rate? It is, right? So let's get into doing some valuation, and we'll begin with bonds. So as we get into bonds, what I'll talk about is, what is it? I'm sure you already know what it is, and we'll get into some terminology, and then we'll get into the valuation, and we'll do what's called a yield to maturity. So what is a bond? Well, imagine these are the cash flows from the investor's perspective. So I've sort of taken a shortcut here. Instead of the two cash flow timeline diagrams I had before, at time zero I got this minus 1100. So that's what the investor is willing to pay today. So from the investor's perspective, is it a cash inflow or outflow at time zero? An outflow, right? But are they going to give that up for nothing? No, they have an expectation of cash flows as shown here that they'll get into the future. So what is when a company issues a bond, what are they essentially doing? They're borrowing money, right? That's a definition. So when a company issues a bond, they're getting cash from the investor today, and basically they say, all right, well, you give us money today, and we'll agree on an interest rate, and we'll agree on when we pay that interest, and we'll agree on when we provide the principal back. So that's an example of a bond. So let's get into some bond terminology. Okay, so something called, and a lot of this is definitional, so I'll go through this relatively rapidly. But the par value is the face value, that's the amount that's returned at maturity. So in this example, that's $1,000. What's a discount bond, do you know? Well, basically, if what you're willing to pay for that bond is less than this par value. So in this case, did you pay more or less than $1,000 for this bond? You paid more, right? You paid $1,100 for this bond in this example. So would this be a discount bond? It wouldn't, right? In fact, that's what we would call a premium bond, when you're willing to pay more than the par value amount. Now, when you want to figure out how much Apple is trading at, it might say, hey, Apple, we're trading at $500 a share, or whatever it is. But bonds are different. That they don't say, hey, you know, we're trading at $500 per bond or whatever it is. What they do is they say whatever their percentage of par value. So in this example, and then they multiply it by 100. You'll see what I'm saying in a minute. So in this example, here's the par amount, 1,000. You paid 1,100. So basically, you could say this is 110%, right? The 1,100 to 1,000. And so this would be quoted as 110. That's how you'd see it quoted. By the way, what's the difference between a bill, a note, and a bond? Sounds like a joke you tell in a bar, right? Well, a bill is basically something that matures with less than a year to go. A note is between 1 and 10 years, and a bond is over 10 years. Okay, so there it is right there. So what's the coupon rate? Well, basically, the coupon rate is the amount of interest that is, or the interest payments, and it's the amount that's paid out annually. And the reason it's called coupon is back in the older days, literally, you'd go to the bank and you would tear off a coupon, and you could only do it at the right time. You'd give it to the bank or whoever, and they would give you the money. So let me illustrate how this works. Okay, let's say you have a $1,000 par bond, and it's quoted as 10% semi-annual. So what are the annual coupon payments? Well, on an annual basis, you know, this is by definition, not understanding, this is just how they communicate the cash flows. You take this 10% and you multiply it by 1,000 and you get $1,000, right? Now, in this case, it says 10% coupon semi-annual. So does that mean you get $100 every 6 months? No, because by convention, this is $100 per year. So what do? Well, you simply divide it by 2 because there's 2 6-month periods in a year, and so it's $50 every 6 months. Yield to maturity. Well, basically, that's essentially the equivalent of a bond's internal rate of return. So, in other words, if you go back to lecture 2, where we talk about time value money, it's the equivalent of solving for R. But in this case, you have to annualize it. And we'll do one of these a little bit later on. But basically, take all of these cash flows, including this negative one here. Does there exist a discount rate such that the answer in the end would be 0? There does, right? And then once you annualize that, that would be a bond's yield to maturity. And like I said, we'll do an example in a minute. Current yield. Well, again, it's definitional. You take the annual coupon payments. So in this example here, how much in coupons or interest we paid annually if these are every 6 months? $100, right? And then you divide it by the market price of the bond. So what is the market price of the bond in this example? Well, you paid $1,100 for it, right? So whatever you're willing to pay for it today is the market value. So in our example, 100 over 1,100, or a little bit over 9%. So that's just some definitional stuff. Let's get into some bond valuation. So again, what 2 things do you need to value anything? At this point, this should be just rolling off your tongue. Cash flows and a discount rate. All right, so let's just do one. So you're told the following. 9% coupon, $1,000 par, semi-annual coupon payments, 8 years to maturity, and the required rate of return is 8%. And the question is, well, what's the value of the bond? Well, before I do any finance whatsoever, what's the first thing I'm going to do? Well, I want to take a stand on the interpretation of the problem. And the only way that I know how to do that is to draw a cash flow timeline diagram. So if we begin, what do the periods have to be? When does some kind of action happen with the cash flows? Well, how often do we get paid interest or coupons? Every 6 months, right? Semi-annual. So what do the periods have to be? 6 months. And how many periods do we have? Well, we've got 8 years to maturity, and they're 6-month periods. So there must be 16 of these 6-month periods. So if we picture it so far, it's going to look something like that, right there, where these are 6-month periods. Okay, now let's figure out the coupon payments. Well, it says 9% coupon, and there's a $1,000 par. So with that information, can I figure out how much I get in interest every year? I can, right? And this is, again, by definition. You go back and look at the bond terminology, and by definition, you take the 9%, you multiply it by the $1,000, and that's how much you get per year. Or in this example, $90. But does that mean that's when you get paid every year? You get a $90 check? No, because it's semi-annual. So what do we do this $90? We divide it by 2, and we get $45 every 6 months. So if we look at what we have so far, it's basically $45 every 6 months that ends 8 years from now. Well, are there any more cash flows? Well, what about the par amount or the face value? When do we get that? We get that at time period 16, right? And so the other cash flow is $1,000. So there we have all the cash flows. What else do we need to value this bond? We need a discount rate, right? Now it says the required rate of return is 8%. So does that mean that I use 8% in bringing all of this stuff back to time 0? I don't, right? Because by convention, this 8%, is that a 6-month number or is that a 1-year number? That's a 1-year number, right? That's the nominal or stated or advertised rate. But as we saw in lecture 2 of these theories, the time value of money stuff, if these are 6-month periods, I better be working with what kind of effective rate? I better be working with an effective 6-month rate. Now, if that didn't make sense to you, I strongly recommend, if you want an understanding of this stuff as opposed to a memorization, I strongly recommend that you go back and you go through the time value of money lecture, because after that gives you a chance of really understanding this stuff. And so what's the only step, or how do I get this effective 6-month rate? What's the only thing that I can do that 8% by definition to turn it into an effective 6-month rate? Divide it by 2. Why? Because there are 2 6-month periods in a year. So if I put that all together, now I have what I need. I have my expected cash flows, and the market's saying, hey, the riskiness that we're applying to these expected cash flows, they're not guaranteed, there's risk inherent in them, that we're applying right now at time 0 is 4%. So with that, can I now apply my time value money stuff to all these cash flows and figure out what it's all worth at time 0? I can, right? What do all these $45 represent? What do we call that? Equal cash flows between equal time periods over a finite period of time. What do we call that? That's an annuity, right? So can I apply my annuity formula? I can, right? And then in addition, I got this $1,000, which is single cash flow. So here's my annuity, $45. I've got how many of these 45s? I've got 16. That's why I put the number 16 there. So all of this brings it back to time 0. This number here is at time 0. And then this is single cash flow principles. and I have to bring this 1,000 back 16 time periods, so that's what I'm doing right there. So my answer is 1,058, which means I'd be willing to pay $1,058 for this bond right now. All right, now suppose 1 second after you purchase this bond, a major risk increasing event happens. Maybe there's an act of global terrorism, or maybe the president of the United States resigns suddenly, and it's not political. I'm not saying risk increasing or risk decreasing, but just a major, well, I guess I am. So in this case, a major risk increasing event happening. And the required rate of return, because after all, does risk change on a second-by-second basis, or is it static? It changes, right? I mean, things happen all the time, just like in the same way stock prices go up and down on a second-by-second basis. Well, is one of the reasons that stock prices go up and down on a second-by-second basis because the risk environment changes? It is, right? So imagine that for this particular bond, the required rate of return goes from 8% to 10%. My question is, what would happen to the price of the bond? And what I'm going to do is I'm going to get into what I might highlight as both a quantitative and a qualitative reason. Although, some might say it's semantics because they're both pretty much the same. In any case, can you tell me what would happen to the price of the bond? Well, it would fall. And let's see why. Let's get into a qualitative reason. Okay. Now, when you bought the bond at time zero, had you essentially locked in an 8% expected return? You had, right? I mean, that's pretty much what you'd locked in. Now, if you'd waited just 1 second, could you have locked in a 10% return? You could, right? If you so basically, here you've got something where you've paid a price that has basically locked in an 8% return, and you wish you'd waited 1 second if you'd known. You do, right? But hey, now you're stuck with something that in a sense, well, you didn't overpay at the time, but you just wish you'd waited 1 second. But either way, what do you have to do to, if you will, bribe someone into making them agree to buy the piece of paper that you're now stuck with? Basically, the way you bribe them is you sell your IOU, this piece of paper where this company or whoever owes you this much money. Do you have to sell it at a higher price or a lower price? You're forced to lower the price. Well, you're forced to lower the price. And so you could think of that maybe as a qualitative reason for why, when interest rates rise, bond prices fall. Well, let's look at a quantitative reason. So these are 6-month periods. We said the required rate of return went from 8% to 10%. So what's the new effective 6-month rate? Well, it's 5%, right? Because the 10% divided by 2 is now 5%. So what that means is that when I'm bringing all of these guys back to time zero, am I dividing them by a bigger number or a smaller number? A bigger number, right? Because before I was essentially bringing them all back at 4%, so 1 plus 0.04, or this 1,000 divided by 1 plus 0.04 to the 16. But now, if we take this 1,000, of course it applies to all these 45s. If I bring it back to time zero, I'm dividing it by 1 plus what? 0.05 to the 16. So I'm dividing by a bigger number. And when you divide something by a bigger number, is your solution bigger or smaller? It's smaller, right? I mean, if you want, just try it by yourself. Take the number 2 and divide it by 1. What do you get? You get 2, right? But take the number 2 and divide it by 100. What do you get? You get 0.02. So basically, when you discount these at a higher number than what it was before, now you get a lower answer. And so, because before, remember, it was 1100. And so what we've illustrated is, in a sense, a qualitative reason and a quantitative reason for why when interest rates rise, bond prices do what? They fall. And if interest rates fall, the converse, then bond prices would do what? They would rise. Well, let me get into a bond yield to maturity. And essentially, this is going to require 3 steps. Number 1, we need to figure out the cash flows, and then we solve for R. And when I say solve for R, that refers to the time value of money series, where that's what I referred to as the discount rate, and then we annualize it. We'll do an example. Imagine you pay $850 for a 5-year, 10% coupon. It's semi-annual, and it's a $1,000 bond. And the question is, what's the bond's yield to maturity? By the way, you should try this on your own. You should pause this and see if you can figure this out on your own. Anyway, what's the first step that I'm going to do before I do any finance? What do I want to picture? I want to take a stand on the interpretation of the problem. So the first thing I'm going to look at is, well, what are the cash flows? Okay, so what do the periods have to be? Well, 6 months. And how many periods do I have? Well, it's 5 years, so I have 5 years of 6-month periods, so that's 10 periods, right? And what about how much interest will I expect to get per year? Well, the 10% coupon times the $1,000, that's $100 per year. Does that mean I get a check of $100 every year? No, because it's semi-annual, right? So what do I do to $100 to see how much I get every 6 months? I divide it by 2. And so I get $50 every 6-month period. And then how much am I paying for this bond? $850, right? And when am I paying for it? At what time period? Time 0, right? So is that a cash inflow or outflow? Outflow. So if we put it all together, basically we get something like, looks like this. Here's how much I'm paying for it today, a cash outflow of $850. Here are the $50 every 6 months coupon payments that we figured out. And then this is the amount I get back at maturity. That's the principal. So what's step 2? Well, now I want to solve for an R, an effective rate that basically, when I put all of this together, is going to give me a solution of 0. Okay. So when we did the asset investment decision, it was their equivalent of the internal rate of return, which is the previous lecture to this one. So what that means is, does there exist an R that I can put in here such that when I bring all of these guys back to time 0 and then subtract 850, I'm going to get a solution of 0. And that does, right? Now, in this example, I cannot algebraically rearrange this particular equation right here. I cannot algebraically rearrange it and say R is equal to something. I could do it with this equation, but not this one. And the reason is that there's an R there and there's an R there. There's 2 of them. And so this would need to be done with either a financial calculator or a spreadsheet. Or back in the old days, you would interpolate or whatever. In any case, if you use a computer, then if I put in the number 0.07151 into all of this, you'd get an answer of 0. So here's my question. Does that mean that I would communicate the bond's yield to maturity as about 7.2%? I wouldn't, right? Why not? Well, is this an effective rate? It is, right? It's an effective 6-month rate. And is that how yield to maturities are communicated on a 6-month basis? They're not, right? By convention, they're annualized. So what would I do to this number to turn it into an annual number? Well, I'd multiply it by 2. Okay, so basically the answer in this question would be about 14%. So that's a little bit about bonds. Let's go to the other extreme, if you will, and we'll talk about stock. All right, so we're going to begin with a general discussion about stock, and then we'll get into a couple of valuation models. And what I want to do is I want to make 2 points. First of all, I want to illustrate that you could think of the value of a stock today as the sum of all future expected discounted dividends. And the next point is that when we look at these stock valuation models, they're basically nothing more than time value of money equations, except they just make different assumptions about dividends or cash flow growth and discount rates. In other words, they're basically making assumptions about cash flows and a discount rate. So let me get to the first point. The stock price today is the sum of all future discounted dividends. So imagine that the stock price at time 1 is expected to be $50, we'll call that P1, and there's an expected dividend of $5, we'll call that D1. Now, if the discount rate that applies to these cash flows is 10%, could I figure out what the price is today, the P0? Well, how would I do that? What would I do to these numbers to see what they're worth today? Well, is that a single cash flow question? It is, right? I'd simply discount the expected cash flows. So would I multiply these numbers by something or divide them by something? I'd divide them, right? So basically, here's the $5 being discounted once, and here's the $50 being discounted once. So this would be worth $50 at what time period? Time period 0. So if I switch to symbols, could I put it like that? That the price today is the expected dividend 1 period later, discounted once, and the expected stock price 1 year later, discounted once. I could, right? And I'm going to call that equation 1. Now, if equation 1 is true, what you see there for equation 2, is that also true? So all I've done is I've said, all right, well, the expected stock price in 1 period is also equal to the next dividend discounted once and the next expected stock price discounted once. I mean, does this equation, is that identical to equation 1 except we've just moved everything along 1 period? So here's a 0 and there's a 1. Here's a 1 and there's a 2, and here's a 1, there's a 2. In other words, if equation 1 is true, must equation 2 also be true? It must, right? And so if I wanted to, could I, for this P1 up here, could I substitute all of this up there? I could, right? And guess what? I want to. So let's see what happens, okay? So up here, I've got all of this. So I've got D2 divided by 1 plus R, but then I divide it by 1 plus R again. So would that be D2 divided by 1 plus R squared? It would, right? And is the same true about this P2, the expected stock price in 2 periods? I'm dividing it by 1 plus R here, but then I'm dividing it by 1 plus R again. So basically, if I do that substitution, we're going to find out that, hey, the stock price today is next period's expected dividend, discounted once, And then the dividend 1 period later, at time 2 in this example, discounted twice. And then, of course, plus the expected stock price in 2 periods, discounted twice. And so what I'll do is I'll call that the new equation 1. Now, if I wanted to, could I do another substitution? Is this true that the stock price at time 2 is the next period's dividend? Here's a 2, there's a 3. Discounted once and expected stock price, discounted once. Could I take all of that and substitute that up there? I could, right? And if I do that, this D3, well, I'm discounting it twice here and then a third time right there. So would that be D3 discounted 3 times? It would, right? And I could argue the same thing with P3. So if we do that, we'd basically get, hey, the stock price today is the expected dividend 1 period discounted once, plus the expected dividend 2 periods from now discounted twice, and so on and so forth. And then finally, the expected stock price down the road discounted 3 times. So we'll call that the new equation 1. So if I wanted to, here was the first equation 1 we had, and then we got to the second, then we got to the third. If I wanted to, could I just keep doing this indefinitely? I could, right? If I continued the substitution, then basically we'd get the sum of all of these dividends, and then finally, years down the road, and if we're mathematical about it, an infinity number of periods down the road, we would be discounting this an infinite number of times. Or if we use mathematical symbols, this funny looking thing right here called sigma, it means the sum. It basically means the sum of all of these guys. If this was between 0 and 3 instead of infinity, it would represent these 3 guys right here. Except we're going to go out to infinity, so we're going to have an infinite number of these guys. And then at the very end, we have the expected stock price an infinite time period from now, discounted an infinite number of times. But what does that mean? Or I should say, what is this equal to? If I'm discounting something an infinite number of times, to be technical, in the limit, in mathematics, they say that it's going to go to what? Well, essentially, it gets back to what we talked about earlier. Are you dividing by an unbelievably huge number? You are, right? Which means this is basically going to equal what? It's basically going to equal 0. Which means, the point that I wanted to make earlier is that you could think of the value of the stock as the sum of all future discounted dividends discounted to today. So in words, the value of the stock price today is the sum of all future dividends discounted to today. Now, some stocks, they've never paid a dividend, because you're probably saying, hey, all right, that's great for stocks that pay dividends, right? But what about stocks that don't pay dividends? So, for example, I don't know this for a fact, but I'm guessing Netflix to date has never paid a dividend. Does that mean that Netflix is worth 0? Would I put the number 0 in here? No, because basically this model, is it about past dividends or future expected dividends? It's about the future, right? In other words, the fact that Netflix is worth something today and it's never paid a dividend must mean that the market at some point is expecting Netflix to do what? Pay dividends, right? It's like Microsoft, right? I mean, they first went public, I think, in 1986, and for years and years and years, they did not pay a dividend. And what happened to their stock price? I mean, it basically went through the roof. I mean, I don't know about you, but I sure do wish I had invested in Microsoft in 1986. And so, the point is that these are about future cash flows and future dividends. And so, the model is not about past dividends, but expected dividends. And what this really highlights is that as an investor, and I'm ignoring tax impacts and information impacts and so on and so forth, but really you could say that capital appreciation and dividends are interchangeable. Because when I tell you that this model is about future expected dividends, you might be saying, well, hang on, what if I don't have any dividends but I sell my stock at a higher price? Well, why do you think you sell at a higher price? The person that buys it, what do they expect? Well, either they expect to sell it at a higher price also, or they expect to get dividends at some point. I mean, the point is at some point, somebody is going to be buying that piece of paper because somewhere down the road, the firm is expected to pay dividends or provide cash. So let me get across this point of as an investor, how dividends and stock price appreciation, you could argue, are interchangeable. So for example, imagine I have a company, and let's say it's worth $40. Here's two $20 bills, and there's just one share. So what's the stock price? Well, $40 a share, right? So if I'm the investor, either on paper, I can have something worth $40 a share, or let's say the company pays a $20 dividend. Now, what's the value of my shares on paper? 20, right? $20 a share, but I have 20 in my other hand, which reflects the dividends. So in other words, again, ignoring some tax implications and information effects and things related to dividend policy, then basically, whether it's a dividend or capital appreciation, you could argue they're interchangeable. So the point is that, yes, these are dividend models, but they apply to whether you're talking about growth of the firm as reflected in capital appreciation or dividends. In any case, you could argue the value of the stock price today is the sum of all future discounted dividends today. Or you could think of that also as again, the trade-off between capital appreciation and dividends. Now, suppose a stock guaranteed, absolutely guaranteed, hey, we will never, ever pay a dividend. Well, what would it trade for today? Nothing, right? And we could try to trust. Hey, you can be my stockholders. Give me whatever you're willing to give me, $100, $1,000, and I promise you that I will never ever give any of it back. Would you be willing to pay me anything for that kind of a promise? You wouldn't, right? Because if you did pay me, if you did give me money for that kind of promise, right? So, for example, if I say, all right, this is how much I'll give you. Okay, so that's how much I'll give you. And you give me $40 in return, and I give you a piece of paper that says, hey, this is how much you can expect to get in the future. So now you own this piece of paper, and then you try to sell it to someone, like what happens on the secondary market. Okay, that's when stock trades amongst stockholders, that's a secondary market. Well, is anybody going to be willing to pay you any money for this piece of paper that says, hey, you can expect to get nothing? They won't, right? And so basically, a stock that is guaranteed to never pay a dividend, the price that it would trade would be nothing. All right, let's get to point number 2. When it comes to these dividend models, given that we've talked about the trade-off between capital appreciation and dividends, and given that we've talked about even for a company that does not pay dividends, does the dividend model still apply? It does, right? Because it's expected that the company at some point will pay out something, some sort of dividend. Otherwise, it's just a big financial black hole. So essentially, these dividend models, all they are is they're time value money equations. And they just make different assumptions about cash flows and discount rate. So you have the Gordon dividend discount model and this model and this model. Guess what? You and I, we could make up 100 different types of assumptions on cash flows and a discount rate, and we could call it the Tompkins dividend valuation model and the Smith dividend discount model. Maybe we could get our name in textbooks, because in the end they're just making assumptions about cash flows and a discount rate. So we'll just talk about two of them. We'll illustrate a stock valuation dividend model where there's no growth and where there's constant growth. So here's one with no growth. Here you have a stock that's expected to pay a $5 dividend every period forever. Imagine the discount rate 10%. Well, is this a perpetuity? It is, right? So can I apply my perpetuity formula? I can, right? So from the time value money lecture, you get C over R. So what's my C in this example? It's the $5, right? And what's my R? It's the effective discount rate, the effective rate. So boom, $50. We've just valued stock. We've assumed cash flows, and we've assumed a growth rate, in this case, or some sort of growth assumption, in this case, no growth. All right, let's do the constant growth one. We also did this in time value money, right? So $2 expected to grow at 5% forever. Imagine the discount rate is 10%. Apply our growth perpetuity formula, which again we did in lecture 2 of this series. So the cash flow at time 1, which is this $2, divided by the discount rate minus the growth rate, and we would get $40. So boom, we've just valued more stock. Great, right? So with this question, does that mean that, wow, I know how to value stock? Are you now armed to make a ton of money on the stock market? You're not, right? Because is there anything special about knowing these time value money formulas? There isn't, right? That's not what makes it special. These formulas are dependent on cash flows and discount rate. So for you to really get rich, if you will, on the stock market, is it because you know time value money? What would you have to do better than the market to get rich, or expect to get rich by trading stock or whatever financial security it is you're trading? Well, you'd have to do a better job than the market at either predicting expected cash flows and or the risk inherent in those expected cash flows. And if you believe that you could do that, then what do you also believe about market efficiency? That the price is or is not efficiently priced. That it's not efficiently priced. In other words, you know something the market doesn't know, which is information, right? That suggests that the market is either overvalued or undervalued a particular stock. And so great. If you don't believe the market's efficient, and obviously it's a relative term and it's a matter of opinion, but when you invest in stock, the fact is that if you expect to beat the market on a risk-adjusted basis, then at least from a rational perspective, it's because you believe you can do a better job than the market at either figuring out the expected cash flows and or the riskiness inherent in those cash flows. So like I said, there's nothing special about this stuff. All we've done is we've applied the time value money to valuing, in this whole lecture, stocks and bonds. And again, what two things do we need to value anything? Cash flows and a discount rate. And we could make up hundreds of different stock valuation formulas by just making up hundreds of different assumptions. Anyway, I hope this has been a good learning experience for you, and we'll continue this series. What we get into next is the discount rate for financial securities, which so far we've assumed. We assumed that in this lecture. And then finally, the discount rate for the asset investment decision. Thank you.